Hello, and a very warm welcome to the Euromoney ECBC covered bond briefing. This month, we're going to be going back to our roots a bit. We've spoken in the past about credit, we've spoken about ESG, we've spoken about all of those topics, but we're going to go back to some of the old-fashioned topics of the effects of interest rates. If there's one advantage of being old, it's that I'm old enough to remember a time when interest rates could go up as well as down, and a time when there used to be inflation. When was that? I suppose the last time was in the mid-noughties, so 15, 16 years ago, when we had a little brief increase in both inflation and rates. But really, you've got to go back to the 1990s before you had a sustained period where rates were what we used to call normal. Now, since then, an enormous amount has happened within the covered bond market. We've seen growth, we've seen diversity, we've tried to rein in that diversity with a covered bond directive, and perhaps we've also seen market capacity reduce. Investment banks put less balance sheet, there are less traders, there are less personnel, there are less investors. How can the market cope with a changing rates environment after so many years of low rates? To help me discuss that, you have the panel that you see in front of you today. All people who have been in the market for many years and have much experience. Olaf Pimper is in charge of Commerzbank's treasury portfolio, looking after their bonds that are eligible for ECB and whatever. Daniel Rausch is one of the few remaining asset managers who are regularly appear in the market. Daniel's been a loyal supporter through the ups and downs in this market, managing the covered bond portfolios of Union Invest. And last but not least, Morten Nielsen, who you will all know as the current chairman of the ECBC, and also the head of ALM and investor relations for Nykredit in Denmark. Gentlemen, thank you all for joining us. Before I start, a couple of points to the audience. First of all, please ask us questions. We love to know that you're out there. We love to know that you're engaged with our conversation. If you have any questions about anything that we talk about, or maybe topics we don't talk about, please post them in the chat room. They will get sent to us. And the second point is a massive thank you to DZ Bank, Helaba, and NordLB for their sponsorship of this. No one prefers virtual to real conferences, but it's absolutely essential at this time that we keep to do them. So thank you to our sponsors for that. So without any further ado, Olaf, one of the most important factors in the market for quite some time now has been TLTRO, all this nice free money from the ECB. But that's going to end in June, or is it?
Yeah, well, the TLTRO is one of the tools the ECB used to get inflation going again. And as we all know, as we all witness right now, inflation is back and probably going to stay with us for quite some time. Therefore, there is no need to go on with TLTROs for the ECB. And this is why my personal view is that the TLTROs will end by the end of the year. Well, what does that mean for our market, for the covered bond market? I think it is one reason why we should expect higher supply from the issuers. And why is that? I mean, the issuers will surely not need covered bond issuances by the same amount they are repaying their TLTROs to repay their TLTROs. I think banks do have enough cash to easily pay back the TLTRO redemptions. However, banks also used their collateral for own issues and placing them as collateral with the central bank. And this is going to be freed up then when the TLTROs end. So this gives issuers more leeway to do public issues. However, there are of course several more reasons also caused by the ECB why we should expect higher supply. One of them is that we all can expect higher rates, and therefore it might be simply cheaper for issuers to issue rather sooner than later. Then the ECB has several buying programs that will probably also be ending sooner or later. So it might be good for the one or the other issuers to come to the market sooner or earlier to have the ECB in the book. We are also seeing quite a high amount of redemptions this year that can be or has to be replaced. And last not least, due to the geopolitical crisis we are facing right now, the covered bond also proved to do what he is supposed to do, to be a good funding tool for issuers in times of crisis, where it was from a relative value perspective much more expensive to issue senior unsecured when the Russian aggression against the Ukraine started, and covered bonds proved to be quite still a cheap funding tool for issuers on a relative value basis.
So on many levels, music to the ear of DCMs everywhere, lots and lots of reasons for more issuance. Morten, Daniel, would you agree that this TLTRO has served its purpose and is going to be phased out, and all of those other factors that Olav mentions for more supply?
Yeah, basically I agree with Olaf, and I think that you can say that the TLTRO it has to some extent crowded out the covered bond funding for many banks in the Eurozone. So I agree with the outlook that Olaf just shared here, and would expect to see issuance of covered bond picking up as a consequence of the tapering of the TLTRO's setup. That is, of course, for the Eurozone. Taking a more, you can say, look closer to home from my point of view. Here in Copenhagen, we are of course outside of the Eurozone, and the same of course for the rest of Scandinavia. And here that it's a bit more unaffected by TLTRO. Of course, it's in that respect it has been more business as usual. We can come back to the to the implications of the ECB's purchase program, which of course also have reflected on interest rates here, obviously. But that's for another topic probably.
We'll certainly come on to that, but yeah, just on this point, Daniel, first of all, let me ask if you agree. I assume you broadly agree with the general hypothesis of there's going to be more supply. And second question for you, a lot of your peers have gone away. They've been put off this market by absolute low rates, negative rates, tend to, not be that appealing to real money investors. To that increase in supply, do we have enough demand? Do we have enough investors?
Yeah, for the first asked question regarding the TLTROs, to be honest, nothing more to add on. I think there's this quite a consensus view we spoke about. But for me, much more interesting is the link, etc., the funding channel, and the less requirement of using that and using much more wholesale transactions leads much maybe, and that's a hope for us, that again much more this kind of, let's say, fundamental analysis we are doing is probably and hopefully getting better paid off in terms of larger and greater diversification in terms of jurisdictions, in terms of issue quality, and maybe brings back some jurisdictions that haven't been in the market at least for the last 2 years. And for me, this is let's say a hopeful, normal, and wishful development of the market. And this is linked then to the second question of you regarding the demand for the market and the number of investors which are still around and maybe are coming back to the market. And additionally to them, what I already said is what we see internal in our company, that the shift and the increase of the risk-free rate did change a lot already in this current year. And what we see is that these, let's say, traditional SCR-driven investors, which made up a huge bulk of the demand we had in the last at least 2 years is now, let's say, added on from other investors, which come back to the market because they say now we don't need to move up the in longer duration terms or in credit quality to get a kind of a decent deal. And if you look on an index level, covered bond indexes is around about 1%, and so one is the tendency to say, hey, that's okay for us, for our demands, and these investors are coming back to the market. So, and if we look at the deals, and as of this morning, we have some primary deals going on, and we see the demand. So I can't see a huge problem that the already existing number of investors would not be sufficient to feed the supply side. So demand is there, and that's the good news.
Mm-hmm.
I can also raise my hand here,
Please,
as I was crowded out indeed in at least to some of our markets. Speaking here about the core covered bond markets, and the reason simply was that we in the bank treasury are not allowed to take interest rate risk, and therefore we have to swap all our exposure out, and that meant in the past, in the last year, that our starting point was a 6 months Euribor, and that were fixed at minus 53, minus 54 basis points. And as a bank treasury, you are always allowed to place cash as LCR collateral with your central bank. And when you're then looking at the core markets where issuers were able to print new deals at levels that were even Euribor minus, you were better left with simply leave the cash with as collateral with your bank. And that changed now with, or is going to change now, with higher rates, with higher fixings, and this really gives more leeway for investors like us to come back to certain markets.
But to understand, you're putting that money essentially at the ECB's lower deposit rate. So,
yeah.
So that's deeply, deeply negative.
It is, but like I said, investing in covered bonds and swapping them is even more negative.
Yeah. Yeah.
Or used to be.
And I suppose this topic I think we'll come on to is the Bund swap spread, but presumably the widening of that has been massively supportive of buying covered bonds, if you think in terms of swap spreads.
Yeah.
If I may just stay on the topic of the investors, just for a short minute comment, Richard. I agree that there have been investors that have been crowded out of this market, and seen from my point of view, I do think we need to re-engage with some of those investors. I think there are a lot of investors who have been forced out of their habitat, so to speak. They were really, in their hearts and minds, they were covered bond investors. They were in the market for low risk investments. But the low or even negative interest rates have actually pushed them to invest in something else that they have perhaps initially not been that comfortable with. They got used to it. And in that respect, I think we need to refresh memories here and there across the globe. Not perhaps so much in Europe, but some of our overseas investors might need to have a refresh of what is covered bonds and why is it worth in investing in. And just on an anecdotal path, I had a meeting with a relatively prominent central bank, in Asia some years ago, and they said, "Look, we are basically an emerging economy, and we cannot justify paying the German government for keeping our currency reserves. It doesn't make sense. We need to find other assets." And some of that argument can be brought for covered bonds as well. So I think there are some of these investors across the globe that we need to re-engage with, and I think they will come back. they were happy investors before, and I think they could be come back and rejoin the club. I'm pretty confident of that.
That's something that I wonder, how symmetrical is it? Rates go down, they go away, rates come up, they come back. I mean, presumably they've put in place credit lines to buy unsecured. They've taken the effort to understand securitizations, whatever the alternative investments are. Those will always be cheaper assets. They will always give a better return. If they've had to go to the extra effort to allocate funds to those markets, why would I now come back? Into the securitization.
No, I buy that argument totally. Because I would also say that I think that is the risk for the covered bonds as a product, that that you can say the purchase program, which have made it difficult to source the bonds, and the very low interest rates, and all the other factors around this have actually, how should I say, educated some investors that used to be core covered bond investors, or anyway prominent covered bond investors, to look at other assets and allocate funds to other assets, and perhaps now after several years they're comfortable with them. They might not see the need to come back to a lower risk asset class like the covered bonds, but I certainly hope they will come back, and I think we should make an effort to at least remind them of the benefits of the covered bonds product. So.
And Daniel, you're within Union Invest, you're a champion of covered bonds, but are your peers on the senior unsecured, the securitization trend, are they more fashionable now?
I mean, the argument of the yield argument was always around, so this for me is nothing new. But the covered product is, at least for our internal demands, and as I said, we see much more also external demand for new clients into the, let's say, low risk area, is stemming from the fact that if you are suffering from a year-to-date very high rates volatility, you would not like to, or that's at least how we see it and how the clients are communicating towards us. You like to minimize as good as is possible your spread volatility, and that's the good news for the coverage at the end. I mean, so, and if you, in the combination of those two, have, let's say, sufficient yield on this let's say, asset class, you are fine with it, and it's dependent on what you expect for the entire rest of the year in terms of GDP growth and what is ahead, ahead of that. And the links and or the spillovers into the spread world, maybe this is something you'd like to limit, and that's maybe from us at least in understanding one of the main reasons why these lost investors are very slowly, but they are coming back, and I think that's good news.
Yes, and I suppose this also talks to our last point about the robustness in a volatile market. As long as things are volatile, covered bonds are going to be a safe place for issuers and investors equally. We bang on a lot about the ECB, but Morten, you're not in the Eurozone, but then there are 8 countries in the EU that aren't in the Eurozone, and 3 very large European markets that aren't even in the EU. But the ECB does kind of rule the roost here. To what extent does, let's be realistic, the Danish and the Swedish national banks by far the most important. To what extent are they forced to follow the actions of the ECB? What's the update on them on these points?
I can speak, I should say, most clearly about the Danish central bank, obviously, and that's very easy, because the Danish central bank only have one policy objective, and that's the currency peg for the Danish kroner to the euro. So their hands are tied completely. They will follow the ECB. The classic joke here in Copenhagen is that the monetary independence of the Danish central bank is whether they should follow ECB at 4 o'clock in the afternoon or the following morning. So you can say there's whenever there have been divergence here, we're talking like 5 basis points or something, like maybe 10. So it's the Danish central bank will follow the ECB completely. Sweden is a different matter, of course. The Swedish kroner is floating against the euros, and the Swedish kroner tend to be quite quite volatile. Also, you can say the Swedish central bank have engaged in quite significant quantitative easing with a purchase program along the lines of what we see from the ECB. So I think the development in Sweden could be different from what we see in the rest of, or could be disconnected. Let me put it like that from what we see from ECB. But I'm not in the forecasting business of policy rates, so I think I'll leave that to someone who is more competent in that area.
So it's clear though that Denmark is going to be following pretty closely the euro, Sweden less so. Are there the same pressures in Sweden though? I mean, are we going to see roughly raising at roughly the same rate hikes, or changes in other policy tools like the deposit rate, like the purchase program?
I think the Swedes have always, not always, but they have been more critical to some of the tools that the ECB has been using in the past. For instance, the Swedish central bank governor referred to negative interest rates as an experiment that they would not like to see again, or see repeated, and they got rid of it. And then the COVID crisis hit, and I think also for policy reasons and for the fear of maybe losing a little bit of face here, they then implemented a purchase program rather than lowering interest rates again back below 0%. But I think I don't really want to make forecasts for Swedish interest rates, quite frankly. So, but I think there's more, you can say, disconnect. Let me just use that word between what the ECB does and what the Riksbank will do going forward.
And then other markets. I know, Daniel, if you've got any views on what the Fed are doing. Clearly, they are way ahead of Europe in terms of the hikes.
Exactly, that's what I would like to highlight on that. I mean, your question sounds like, I mean, that the ECB is ahead of the curve, and I think there's kind of consensus view that it's rather the other way around, so it's rather behind the curve. And if you look at, let's say, just the jurisdictions where covered bonds are around, one can argue that, for example, Aussie and New Zealand already, or Canada, the central banks have already started, and the ECB is still watching, and presumably because out of this higher and higher and very dynamic evolution of the inflation side is now acting, and maybe acting obviously faster than most of us maybe expected. So it's not that, it's for me, it's rather the other way around. Other markets have made up the way, and the ECB is now following, and countries like Denmark or Switzerland, which their central banks are very close to the currency packs, they are following. But look at let's focus on, let's say, a rather European scale. I mean, you have Poland, you have Hungary, and all those countries we all also have cover bonds around. They already have started their interest hiking cycle, if you want to, depending on how the future you're looking at that. So it's not just that the ECB is making up the market, and for us, this means like that we now start much more and that's maybe what we didn't do in the last 2 years. I mean, we are euro-denominated investors, and this will not change that dramatically. But what we do more and more is that we are looking into the, let's say, foreign currency-dominated issuances, and if maybe there is an opportunity to invest. Hedging out the currency risk or not, this is depending on our market timing, but this opens up a little bit, as I said, but this will only be a very, very small portion of it, but at least this opens up some maybe new investment ideas for our clients.
Whatever the speed in the respective currency, look, fundamental story is that rates are going to be going up for the next few years. Now, as an investor, obviously, you like your bonds to go up in value. interest rates going up, cover bonds traditionally have been a high duration product, particularly compared to, I don't know, securitizations or unsecured bonds. And from an issuer's perspective, compared to TLTRO or deposits, which are very short duration products. Prices of bonds are going to go down. What maturities, what duration do you think the market's going to move towards? Let's have first crack at that.
Yeah, I can take that one. At least for us, and I think most of the usual market suspects know that quite well. As we are not an insurance company, our let's say, natural starting point in terms of maturity is around the 5 years area. The longer it goes, the bigger is the deviation to our, let's say, standard new duration of the indexes, of the benchmarks. And so we need, let's say, good arguments to go longer in terms of the tenor. And in combination with our market forecast, which to be honest is quite consensus as of now, there is no real demand for longer tenors. So 5 years is really kind of a sweet spot for us. I mean, as of yesterday, I mean, the sorrows about the corona dynamics in Beijing maybe starting a little bit changing this very rapid increase of the rates, what we're going to see, and didn't change that much of, let's say, our preference of tenors. So I think really the sweet spot will be for let's say, the largest share of this year will be around the 5 years area.
Olaf, would you agree that 5 year is the sweet spot given the dynamics?
Yes, I do indeed agree with Daniel, and the reason is that yes, it was quite easy for issuers to issue in the very long end of the curve. This was when interest rates were very, very low in the front ends, and investors were forced to go out the curve in order to receive a decent yield. And now with the increasing yield environment, it is simply not necessary to take that long risk as long as you are not an insurer. And so also speaking for bank treasuries, we are also happy right now to stay at the short end of the covered bond universe, that is 5 years. And also, please don't forget that we are in between geopolitical crisis that is still looming and is still here and is still leading to very high yield volatility on a day-by-day basis, with 100 ticks in the bond future being quite normal right these days. And when you have such a strong volatility, people usually tend to invest in shorter durations, not in longer. And you can also witness this fact in the secondary markets, where it was quite difficult to find decent bids for longer tenors, but still quite easy to do so in the short end. Yeah. And therefore, I do agree. 5 years being the sweet spot. We ourselves, due to the high volatility, decided that 7 years is going to be our longest investment horizon, and that changed from being 10 years before.
Purely because of mark-to-market risk on the increase in duration, is that?
Of course it is.
Yeah. Right. But it is a bit of a strangely shaped curve, isn't it? The beyond 5 years is very flat, and 2s to 5s are quite steep at the moment. Is that rationale for that?
You're right, and that's another argument to limit, and this is linked to our expectation of spreads. And at the very beginning, we had regarding TLTROs, we had a link to maybe the further supply this year, and we expect gradually, but some more spread widening also in the covered bond space. That's our internal estimation, and this is directly linked then to the credit curves themselves. And yes, you are definitely right. we regard, especially starting from the 5 years, but also you can maybe say 7 years and later on, these curves are just quite too flat. So there's kind of this missing credit premium is not sufficiently around for us. I mean, as I said, we have a natural hesitation to really move longer, but in combination with, let's say, this flat credit curves, there's for us there's still a really high obstacle that we need to overcome, that we would go longer in duration.
Yep.
And yeah, you're right.
We're all used to the fixed rate market, but I've actually had a couple of questions, I think, from the audience about floating rate covered bonds. That's an idea which comes up every so often, but never seems to materialize. Morten, we're going to start seeing floaters?
Yeah, I think I'm actually the only issuer in Europe who actually tried to do it. We actually have exactly. No, we did it actually. As a matter of fact, we have a. I think it was originally a 5-year floating rate covered bonds denominated in euros, so completely plain vanilla euro issuance. And if I remember correctly, it matures here in August, if I remember correctly. And then, and back when we did it, we actually made a proper roadshow to go and market it, and there was quite decent interest actually, because most of the treasuries, they are swapping it back to floating anyway. So and I can't recall all the nitty-gritty details, but I think they are excluded from some of the indices as soon as you go to floating rate note. But there might be other people on the panel here who can correct me. I'm not quite sure about that. Anyway, I think it has merit, quite frankly, and especially at these days and age where we see interest rates coming up. I think it makes a lot of sense, and just to tie that into what we see on the issuance side, of course, in Denmark we match fund everything, so we just issue whatever our customers want on the loan side, and here we have seen quite a shift from locking into 30-year fixed rate mortgage products, which is reflected in our issuance of 30-year fixed rate callable covered bonds, and we see the customers actually going down the spectrum and locking into 5-year fixed, which give rise to issuance of 5-year bullets, or actually floating, which means that we then issue floating rate notes with a maturity of 2, 3, 5 years. So I think it makes a lot of sense, and the floaters that we issue in bulk actually in Danish kroner, they are primarily picked up by Danish banks for their LCR portfolios. So if it works in one currency, why wouldn't it work in another currency? I think it's more down to technicalities actually.
Yeah. Olaf, presumably.
You'd love the difference between fixed rate and floating rate bonds, also from an investor perspective, who is indeed changing fixed to float, is of course the optionality that is involved in the floating rate note, with the floor at 0 that you don't have on the fixing side of the swap, and it might not be possible for any investor to risk calculate correctly the volatility involved, or on the price that the floor should show. And with rising rates and positive rates at the end, we might well see a revival of floaters, because I really do think that the very low interest environment was the main reason for floaters, that there wasn't enough demand to do large issues.
But you are right about the technicalities and the flows. I mean, the bonds we issue in Danish kroner, they don't have a floor. They just fix in negative territory. So it works. But again, there are technicalities involved with why that will not necessarily work in euros. But anyway, from a intellectual point of view, it is perfectly doable, and it works in Danish krone. I can just share that at least.
If you have a 0% floor, just thinking out loud, does that technically make it a structured product? Is it still eligible for ECB if it has optionality in it?
I think the problem for the ECB is actually that it can fix negative, or if it can fix negative, I don't think it's eligible for at ECB. But again, not my line of expertise, but it's
Yeah, they were eligible.
They are eligible with a 0 floor.
Yeah.
Okay. Right.
Funny enough.
If anyone in the audience has any views about whether FRNs are index eligible, that would be a great time to post it into the chat room.
To get us out of our ignorance. Yeah.
This is one of these things. Raising rates has all kinds of implications. We don't really understand a lot of the technical ones. We've also had a question, and it's a topic that I did want to get onto. I know this is supposed to be about rates, but it's also a little bit about credit. Look, rising rates reflect in mortgages sooner rather than later. Are there any major credit implications of a raising rate environment with house prices being so high? And we've had a related question in the chat room from a pessimist talking about a recession and whether, if there's a world recession, which I guess is quite likely, is the demand still there? Is there still going to be the same amount of supply? So credit issues and rising rates.
Well, as a lender, I can start on that. I think generally you asked about major credit implications, and I think no, not really. There might be a little bit, but I'm not really sure interest rates are the main driver here. I would be more concerned about energy prices and inflation in general, and hence purchasing power of all the homeowners that we finance. So I don't think I don't think the rise in interest rate will change a lot in the short term. Also because there are actually quite a lot of mortgages around that are fixed rate for shorter or longer periods of time. So I would say energy prices are probably a bigger concern right now. But obviously higher interest rates will lead to a decline in affordability for homeowners, and hence it can actually have knock-on effect on house prices. But I mean, for this to have any implication in reality on risk, we need to see unemployment rates going up. That is the main driver of credit risk for mortgages, at least when you look at private individuals. So with the labor market that we are seeing across Europe, with basically shortage of labor, I would say that that's I don't see any major credit deterioration in the short or even medium term. But obviously geopolitics are a big issue here. So we can see other things, and if higher interest rates are, as a secondary effect, is slowing down the economy substantially, then of course we just have quote unquote a normal slowdown, a normal recession, but I don't see anything dramatic.
And Daniel and Olav, on this point about affordability, do you worry about the number of resets of mortgages, the effect on house prices and affordability on credit?
Just taking up the point with the recession, and now focusing on our internal forecasts, we don't foresee as of now, and that's pretty much what Morten already said, really a very sharp and very in short term a kind of a link to as something you could consider as a recession. There will be a drag on that. As of now, we considered it rather limited. So that's the first point on this kind of recession question. And the second point regarding the credit quality itself, I mean, one can argue on the other side as well that in some jurisdiction, and I mean, I take the German example right now. I mean, if you look at the last 5 years, out of this low interest rate environment and the evolution on year-on-year price dynamics in the housing market, one could also consider this not as like, let's say, normal or healthy evolution in this kind of respect. So this is the other side as well. So if we would see at least let's say a stagnation or a slow or limited let's say a drop in house prices, I would not consider that as a huge problem at all for covered pools.
Okay.
And neither do I, and I totally agree with Daniel. Again, and please don't forget that many issuers or jurisdictions foresee a stress test of the collateral pool with exactly what we are talking about, sharply rising interest rates. And we should give some trust to those as a stress test as well. And I think you can read from the templates, from the HTTs, what impact that should have on the collateral pool. Yeah.
Those stress tests, yeah, it's interest rates and affordability, but does it also take into account fuel prices and all of those other things? I mean, are those stress tests sufficient?
We will see, but I mean, I do agree with Martin's view that increasing energy prices, increasing food prices are more of a concern right now than higher interest rates for floating rate mortgages.
Yeah. Okay. Can I move on to a different topic about competing supply? And this next generation EU program is immense. I forget the final number, but it's an enormous program. We've got this energy security program being launched. We don't know how large it's going to be or what it's going to look like, but it will be another enormous competition. There's a huge amount of supply from the agencies and supras space. To what extent is that a substitute, a threat to supply demand dynamics for covered bonds? Olaf, do you want to kick off with that? Or?
Yeah. Well, those new generation EU bonds, yes, they are large, and when you are looking at the book buildings with billions and billions of orders, we are in kind of different league here, playing compared to covered bonds. We are more in the government space from my point of view, and I also do think that many investors are seeing those NGEUs as a surrogate for government bonds rather than covered bonds. As they are LCR eligible, we also do buy those EU bonds, and as they are also seen from a credit perspective more as a government bonds rather than credit, we also tend to get more credit lines for those bonds, and this is why we have more room to invest in those. However, we would of course still look at the covered bond as they are usually offering higher spreads.
I'd like to ask the same question to Daniel. Before I do, though, Olaf, we spoke briefly about Bund swap spreads. Do you think about SSAs and covereds in the same Bund terms or swaps terms, or?
Now, to be honest, I am totally focused on swap spreads.
Okay.
And but on the other hand, if there are a lot of investors who are comparing the spreads of the covered bonds to the Bund spreads, it does look very attractive these days, doesn't it? And I think the reason why the Bund covered bond spread increased was only due to the spread performance of the bonds, not of the covered bonds, who used to be quite stable. And there are other reasons for bonds trading as expensive as they are. I think we had some repo issues at the beginning of the year that made them and what else? we of course have the safe haven bit due to the crisis, and those are factors that led to deeper bund spreads.
And Daniel, I guess two questions to unpack there. Do you think in terms of bund spread or swap spread, and perhaps more importantly for this question for you, are agencies competition?
Let's start with the second one, with the competition. I think there is to some degree a link, but the link is much more related not in terms of credit quality. It's much more linked towards the tenor, because these bonds from the new big elephant in the room, we know from the schedule, from the announcement, will be long tenors. So I think there is a direct link then to longer agency and due to spillovers, also to maybe longer tenors in covered bond space. So especially from jurisdictions which are much more in the core markets. And I mean, next GU, they consider something themselves maybe as something between, let's say, close to, let's say, a French Gavi spread maybe. Yeah. So and there are issues around that territory. So I think they, in combination with the tenor and let's say jurisdiction, there will be some linkage to that. And as I said quite some questions ago, we consider our credit curves, generally speaking, too flat. So yes, I expect for these part of the curve some spillovers, to say that. Is it a lot? Is it, how much is it? I mean, that's something about guesstimation, but at least there is something you can feel maybe or see in the market. And a link to that is maybe the first question to the bond swaps. I mean, obviously, we do not swap the issues because we want to have those fixed coupons in terms, maybe, as I said, and that's one of the arguments for the 5 years area. We always optimize our portfolios in terms of the roll down, and in the 5-year spot, you have this is one of the largest, the steepest parts of the curve. So you on a let's say annual basis, you optimize your return, your performance on that. And so the link towards the bond swap spread is then obviously just an overweighting and underweighting in bunds. And I mean, to be quite honest, and I think that is nothing that would surprise somebody, is we largely underweight as a result of the last years in bund exposure in our portfolios. I mean, you can't sell your client something that you are holding bunds in the deeply minus area. So obviously, and so obviously that hit that we took in this year was felt. We could, due to our let's say healthier or good duration management, we could overcome it a little bit, just being short in duration. But obviously, this impact was felt, and something which needs to be looked in the forecast is, I mean, we are on the elevated levels on historical basis, and what would we expect there? And I think this is pretty much consensus. We rather expect a very sideways evolution, because there are in the research, there are several arguments around why this level is as it is, and so we don't expect a quite dramatic and fast fall and collapse in bond swap spreads to, let's say, normal, or what is normal, to levels that we have seen in the last couple of years. And additionally, with this, let's say, if you are an investor, as Olaf said, you're looking on your deposit rate, so you are linked to the bond level, then this is already again and still, and for the rest of the year, good news for the covered bonds, because then an investor and risk-averse investor is saying, I'll take this 50, 60 basis points more yield for, let's say, proxy safe credit quality, and that's a good news.
Mm-hmm. Another thing, we're talking all in terms of bunds, but certainly I remember a few years ago now, we were talking about the spread between govies and covered bonds for each individual country. And you remember famously, was it the Italian trade started coming through, UniCredit started coming through BTPs, and clearly there's a strong correlation between covered bonds from a country in the periphery in particular, or Southern Europe, or whatever you want to call it, and covered bond spreads. But we've no idea what this new program that the ECB's floating is going to look like, but it's some way of limiting the spread between BTP and bunds, whether it's some kind of backstop, a Lagarde backstop on differentials. Can you speculate about what that will look like, and more importantly, how will it affect OBG to fan brief spreads?
I take that one. Obviously there is a link. As you said, there is nothing concrete out. I think the ECB is preparing something, and as I assume they have a close watch on their previous programs and the effectiveness of those programs, and they maybe are trying to establish kind of a ranking, which would be the first instrument of choice to come up the markers and something. I mean, there is you can imagine several ways, but at the end the goal is quite clear, as you referred to stabilize in, let's say, maybe in a range certain spreads between jurisdictions, between countries. And if that's the case, and if, for example, it's successful, and then I mean I could also imagine that the market is challenging the thresholds, so we end up in a rather volatile phase maybe then again, to see how big the bazooka gonna be look like. This is the market's usual habit, and if this is happening, then there is a link to coverage and to spreads, generally speaking, and does it lead then to a larger or narrower spread between OBGs and BTPs? We're gonna see. I mean, at least looking in history, do we see maybe in some years a change in terms of paradigm shift, in terms of that, like looking like the other jurisdiction, that OBGs are trading in comparison to the PTPs on a higher yield or spread level, then this, because now it's the other way around. We're gonna see, but at least I would assume in that case that the thresholds and the limits are tested. There is a link also to the spreads in the covered bond space.
Olaf, Morten, what are your thoughts on this? I mean, if the Italian government, Italian covered bond spread is what it is, if you artificially repress the BTP spreads for buying, does that have a knock-on effect because they're substitutes, or is it irrelevant because it's about information and the pricing of Italian credit?
I think it's really difficult question, actually, and I think there are also other factors in that, but of course I assume, as was just said, I mean, investors will also look at relative value. So I don't think it's necessarily an automatic response on this. But at the end of the day, even with the covered bond directive harmonizing a lot of things on the structures, there was still, when you look across in countries, there are still differences, and at the end of the day, you can say that the covered bonds are built on collateral. It is, even though we like to talk about it as a rate product, and I think to some extent it is. At the end of the day, there is also a credit element in it, and therefore I'm not sure you can make a one-to-one relationship between the government spread and the covered bond spread. So I'm a bit unclear on that, quite frankly. But I think especially for domestic investors, there might be some there might be some additional bid from domestic investors, at least, that will have a preference for whatever jurisdiction's bonds we are talking about, and then they might follow the spread down if government spreads are compressed, I would assume. But I don't have a lot of firm views on that. I think it's to me it's a bit unclear, actually.
54 minutes into a 1 hour panel before someone mentions the covered bond directive. That is a record.
That is a record, actually. Yeah.
Olaf, can I give you a choice? I don't know if you have any thoughts on this BTP OBG spread topic. If not, I've got a reserve question, which is what's happening in secondary market liquidity? Or you can answer both of them.
Well, maybe briefly on the OBG and BTP point of view. As bank treasuries are pretty heavy regulated, we usually tend to look more on the government bond when the spreads are higher than those of the covered bonds, as banks don't have to use any equity for European government bonds rather than for covereds, and therefore it really might make sense to take a closer look at the government credit rather than the covered bond. And now turning to the second questions and secondary market liquidity. I have to admit that I was quite happy with the covered bond secondary market liquidity during the last years. There were bids, there were offers. On the offer side, you only should be willing to pay the price that those covereds are offered. And if you are happy enough and being able to wait until primary supply pops up, but that might have been the better choice, because you are usually offered also a new issue premium by the issuers. Of course, also we have seen times where they didn't have to pay any new issue premium, but those times are over. And those were also the times where you can say that the screen prices you have seen were not the prices where you would have been able to really buy the bonds in the market. But I really didn't see any scarcity. So maybe in the one or the other issue, but not talking about the whole covered bond market.
Daniel, would you agree with that? And particularly to my opening point about investment banks' commitment to this market and how much balance sheet and how many traders they have. Would you agree with Olaf's comments so far? And what do you think secondary liquidity is going to look like in a raising rates cycle?
First point, I completely agree with Olaf. We have been in the less lucky situation. We just have tended to wait until in the primary market is popping up. We had a little bit of a problem because, as we know, in the last couple of years, the usual tenor was rather in the 7 to 10 years area. And as I said very previously, this is not our, let's say, main target for our tenors. So that it happened that we didn't participate in that degree, but maybe we would have otherwise done so. But just looking at this year, I mean, a lot of issuances have been in this below 5 years area, and we have been happy to see to participate and put our money there, because in the secondary market, obviously, this area, this tenor area was just, there was nothing left anymore. So there were no, to be honest, as a lot of offers haven't been around. So we have been pretty lucky to be able to then, take that part in the primary markets. And secondary market, generally speaking, over the last couple of years, I mean, one have to admit, obviously, our average ticket size obviously went down. So I need to say maybe for the, let's say, smaller average ticket size, there was enough, let's say, or sufficient liquidity in the market. But it happened from times to times that when we had, let's say, some portfolio trades to do, we saw very quickly also in the covered space that balance sheets from banks haven't been maybe that huge that maybe one would have expected. And I could imagine that maybe some banks, maybe as yields are, as we said, some interest from, let's say, lost investors is coming back to the market, that maybe some banks are thinking maybe about increasing their risk weightings, their risk capital, maybe again towards the covered bond trading book. Mm-hmm. And then in combination with this ECB that is, let's say, more and more going out from the market and leave the market as a market. I consider it as a good news. then maybe this kind of liquidity get its kind of real test phase. This is still ahead of us when, let's say, these disturbing factors are maybe evaporating, and we see a more, let's say, normal market behavior, and then I would say then we can really test about, is secondary market liquidity good or not.
A test to come, but basically quite a positive note. So thank you so much for that, Daniel. Thank you, Olav. Thank you, Morten, for your contributions today. I'm annoyed that we've run out of time. We had plenty of other questions, including some from the audience, for which thank you very much. Can I also say, again, a huge thank you to DZ, Helaba and NordLB for their sponsoring of this session. They've been sponsoring through the virtual panels, but the fantastic news is, well, it's not, virtual panels aren't at an end, but we are starting to see the first physical panels. So please make a note in your diary of the 17th of May, where we're going to have the first physical panel in this series in Frankfurt, where we're going to be talking about ESG factors. And then the 1st of June, we're going to be visiting Morten. We're going to come to Copenhagen to talk about the Nordic markets. Fantastic. Looking forward so much to that. Thank you so much for watching. Thank you, ECBC, for being co-sponsors. This whole presentation today is going to be available from tomorrow on the SwapCore platform. Please share it with your colleagues if you think it's useful for them. Thank you so much for watching, and thank you for all of your questions. See you in Frankfurt.